what drives asset prices is how conditions come in relative to expectations. And
Right.
so what we saw to the start of 25 was a very different set of expectations, whether it was earnings growth that was in the high double digits expected over the course of the year, as you mentioned, or it was, you know, real GDP growth expectations at nearly 3%. Those were very high expectations. Leave aside even the subsequently learned ambiguity about the new administration's policies. Even before we got that hit into the markets, injected into the markets, expectations were sky high, and it was going to be tough to beat those expectations for another year. And so that's sort of what set up my view of this sort of curb your enthusiasm idea of, you know, don't get over your skis, don't get too excited about things. And that's largely played out. Now I think we're transitioning to a point today where we're starting to see a set of federal government policies that, you know, one could argue whether they're beneficial in the medium and longer term. It's relatively clear that they are growth negative in the short term. And part of what we're seeing in terms of pricing more recently is not just a growth scare. It's a
Mhm.
recognition, I think, across market participants that there's both volatility in terms of what the policy outlook looks like, but also, let's say, a slower growth bias in that collection of policies. And so that is not fully priced in the market. A lot of the euphoria post-election has been priced out, but we
Sure.
haven't really seen a big downshift in expectations beyond